When we talk about risk in a portfolio, we don't just look at returns going up and down randomly. Instead, we try to understand why they move. This is where risk mapping comes in. Risk mapping simply means linking each asset's return to common market factors like interest rates, stock indices, or currencies. Some risks affect almost everything in the market, while some risks are unique to a single company. By identifying the right factors, we can split the total risk into meaningful parts and understand where our risk is really coming from, rather than just guessing. Now, first comes general risk, also called systematic or market risk. This is the risk that affects many or all assets together. For example, if interest rates suddenly rise or the stock market crashes, most stocks and bonds will fall at the same time. Even good companies cannot escape this. This type of risk cannot be reduced by diversification because it comes from the overall market itself. We measure how sensitive an asset is to the market using something called beta. A higher beta means the asset moves more strongly with the market. So if the whole market drops 5%, high beta stocks may fall even more. Next is specific risk, also called idiosyncratic risk, which is completely different. This risk belongs to individual assets. It comes from company-level problems like poor management decisions, bad earnings, fraud, or product failure. For example, if only one company reports huge losses, only that stock crashes while the rest of the market may stay stable. The good thing about specific risk is that it can be reduced or almost eliminated by diversification. If you hold many different stocks, the problems of one company get balanced out by others, so the overall impact becomes very small. To model this mathematically, we say each stock's return has two parts. One part explained by the market and one random part that is specific to that stock. In simple words, stock return equals market effect plus company effect. When we combine many stocks into a portfolio, we calculate the portfolio beta as the weighted average of all individual betas. This tells us how sensitive the entire portfolio is to market movements. So instead of tracking each stock separately, we can understand the portfolio's behavior through this single number. As we add more and more assets, specific risk keeps shrinking because diversification cancels it out, but market risk always remains. That's why people say diversification removes specific risk, but not market risk. So the big takeaway is simple. You can control company-level risk by spreading your investments, but you can never fully escape the ups and downs of the market itself.